traders make in trading is trading without knowing the market directions. In today's video, I'm going to show you how to identify market structure so you can better understand the market, if it is moving upwards or downwards or even on a sideways. But before we get started, for now, for those who are new here, my name is Boy11 and you are welcome to the Zone Trading. On this channel, we share forex education, weekly market outlook, trade recaps, and market insights designed to help traders improve their understanding of the forex market. If you are interested in this type of content, make sure you like this video, subscribe to the channel, and turn on post notifications so you don't miss our future uploads. Now that that is out of the way, let's get right into it. So what exactly is market structure? Market structure is simply the pattern that price creates as it moves throughout the market. Trader uses this to identify whether buyers or sellers are currently in control of the market. Before we start identifying market structure, there is one important thing you need to understand: the time frames. The time frame you use to identify market structure should match the type of trader that you are. For example, if you are a swing trader, you may focus on the daily or 4-hour time frame. If you are a day trader, you can focus on the 1 hour, 2 hours, or even lower time frame. The key point is that market structure exists in every time frame. What changes is the time frame you are using to make your trading decision. Like I always say, the time frame where you find the market structure, that is your trading structural time frame. So now let's look at how to identify market structure. On my screen here, we have these lines showing that the market was from this level going upwards, creating this movement is what we call higher high, higher low, higher high, higher low, which means this high is higher than the previous high, and this high is higher than the previous high. This new high is higher than the previous high. This high is higher than the previous high, and so on. Then we have our lower low, which means this low is lower than this low. This low is lower than this low. This low is lower than this low. So combining both together, we have our higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and so on. Then on the other part, we have the market going down. After creating series of higher highs and higher lows, you see the market started shifting in structure. Now it's not creating lower low, lower high. Lower low simply means that this low is lower than the previous low. The new low is lower than the previous low. The new low is lower than the previous low, and the high, this high is low. This high is lower than this high. This high is lower than this high, and this high is lower than this high, and so on. So combining both of them together, it gives us lower low, lower high, lower low, lower high, lower low, lower high. These are the criteria of having a market structure. So if you are a daily time frame trader, you want to see something like this on the daily time frame. If you trade from the 4-hour time frame, you want to see something like this on the 4-hour time frame. If you trade on the 1-hour time frame, this is the exact same thing you also want to be looking out for, because market structure prints out on every time frame. The difference is what time frame are you trading for? What time frame best suits your daily life? Then for the higher highs and higher lows, we've already identified that this is called the bullish market structure, and this is the bearish market structure. Then we also have the ranging market structure, which means the market is neither going up nor coming down. It's just ranging in a particular box. As a trader, you would want to stay away from this, unless of course you are advanced, you've already mastered the market already. So other than that, I would advise, as a beginner trader, you trade with the trend. And by trading with the trend, it means either the market is going up or coming down. And if it's going up, this is exactly what you want to be looking at for higher highs and higher lows, higher highs and higher lows. Then if it is coming down, you want to be looking at for lower lows and lower highs. It's that easy. Oh, excuse me. First of all, let's get right into the chart to see what this actually looks like in on the real chart. Let me take all of this out. I'll leave this on for now. Okay. So on the chart here, this is the daily time frame of AUD JPY. As you can see, it's clear as day. With our previous explanation on the lines I printed out, you could clearly see that this market is going, on a bullish market structure. How do we know the market structure is bullish? The market is creating higher highs. If you check on this high, after the breakout of this structure, we got a new high around here. After the break of this high is higher than this high, meaning this is now higher high, higher low. Let me use the lines for the higher lows. Then from here, the market pushed up all the way until we got a breakout to this level around here. Now we have a new high in the market. This is the new high. Then we got a pullback into this level. This high is higher than this high. This high is higher than this high. So that is where we get our higher high, higher high, higher high. This is a new high, so this is also our higher high, higher high. This is a new high, higher high, higher high, 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 and so on. So it's clear as day that this chart, this is a bullish market structure. So to identify our lows, the lowest point of the market before the market creates a new high, that will be our higher low. This was the lowest point of this market before we got this whole push. Then the market pulled back into this level. This is now the lowest point of this market before we got a new high. So this is our low. We got a new high here. This was the lowest point of the market before we got a new high. This is our low. We still have the same low here. This is a new high. This is the lowest point before we got a new high. This is our low. Then we got a new high around here. This is the lowest point. Let me just identify the high. I'm using the box to identify all the highs. So if this is our new high, this is the lowest point that the market got to before we got a new high here. This will now be considered as our higher low. New high, low. This is the lowest point before the new high. This is our higher low. So this is exactly how you identify market structure from your structural. This is not our entry time frame. We are only here to identify the direction of the market in order to trade with it. We only want to come here to identify the market structure. Not until the price is now on our area of value, we don't go out of this time frame to start looking for an entry. So on here, on our market structure time frame, be it the daily time frame, the 4-hour time frame, the 1-hour time frame, you want to look out for a clean market structure on your market structure time frame. So this is the bullish part of this movement. So let's take a look at the bearish aspect of this. Good. So if you can see, we had a low here. Let me remove this one. We had a low here, high, lowest point, high, lowest point, high, lowest point, high, low, high, low, high, low, high, and so on. So these lowest points that this market is creating while on a downtrend, this is clearly a downtrend. If I bring out a 10 years old boy here now and ask him what exactly is this market doing, it's easy to tell me that the market is trending down. So how do we participate from this move? It is through market structure. So all we want to see is for the market to keep on printing lower lows and lower high. And how do we identify a lower low? This is a low. Then the market pulled back into this point. This was now the highest point of this market. Then it pushed back to break this previous low, and it gave us a new low around here. So this is now our lower low. Then from this lower low, the market gave us a pullback into this point. This is the highest point of the market. That makes this level our lower high. Then from this lower high, the market pushed down to this level. This will now be considered as our new lower low. Low, low, new low, new low. As long as the market keeps giving us new lows, they are all considered as our lower low. And then when the market, to know where our lower high is the highest point that the market pulled back to before creating a new low is considered as our lower high. This was the highest point before this breakout. This was the highest point before this breakout. This was the highest point before this breakout. Same thing here. Highest point before this breakout. Highest point before this breakout. Highest point before this breakout. So this is very easy. A lot of people confuse this when they start seeing little confusions that most traders do have is, let's take a look at this level right here. You see, when the market got to this level, we already had our new low here. Let me highlight it out. This was our new low after the market broke out from this previous low. This is the highest point that the market, this was the highest point that the market was at before creating this breakout. Let me identify this highest point here now. And this is the lowest point. So after breaking this level, you see the market retested this level, but not so much. Then came back into this level to tap into this level. Then it just keep going up. A lot of traders will want to start mistaking this as a change of character, and now we are entering a bullish market. They will say we are now on a bullish market because the market is now creating higher high, higher low, higher high. You are not wrong. But if you are a daily time frame market structure trader, if you are a day trader and you are seeing this on the 1 hour time frame, this is very correct to start taking buys around here, take profits around here. But if you are a daily time frame structure trader, you would want to ignore what is going on here. You want to ignore what is going on here because take a look at the bigger picture. The move started from here. The move started from this level. This was the previous lowest point, and this is the highest point. The market sellers took control over this market from this level and pushed down to this level. So as a daily time frame trader, you are not concerned with whatever that is going on between this level and this level. It's considered to be a range. This is not supposed to be your business. Not until the market is closing, breaking and closing above this major level that the market started from. You don't consider this to be on a buy trade. It is still a selling market. So even if the market is to start doing something like this, let me take out all of this first. Even if the market keeps on pushing up, this is still considered to be a downtrend, not until the market break and close above this level. Because this market, as long as we are concerned, this market has every right to come back and retest this level. It can come into this level and then drop massively. So this is still a downtrend. As long as we are still below this resistance level, this is a downtrend until the market break and close above this level. The same thing applies to a bullish trend. Yeah, like this. As long as the market keep printing higher high, higher low, higher high, this is the highest point of the market and this is the lowest point of the market. The market has every right to come down into this level to retest it and then just keep on going bullish from here. Not until we are not changing from bullish to a bearish market just yet, until there is a break of this level. As long as the market on the daily time frame is breaking this support level right here and closing below, then we should be ready for potential change of structure. So other than that, this market is still bullish. So what you want to be looking at for on every market structure is the beginning of the move and the ending of the move. The beginning of the move and the ending of the move. Not until the beginning that created the push has been violated, there is no change of character. An example of that is from here. You see, from this level now, the market created a low here. This was the low of the market, and this is the highest point of the market. Let me quickly remove all of this. The market created high. This was the low. Then it created this new high. Then it came back. You see how the market was breaking below this level, but it could not hold. This was a weak rejection. This is telling you that buyers are still in control of this market. So the market came back into this level, cleared this level, but failed to close below. Had it been it closed below this level with the body of the candle like this, a full body like this, we would have started considering that, oh, the market wants to change direction. But since that did not happen, we are still very much, you see how we went bullish. So whenever you are coming into the market, the first thing I want you to do is forget about indicators and focus only on price. When price is making series of higher highs and higher lows, buyers are in control and the market is generally trending upward. When price is making lower lows and lower highs, sellers are in control and we want to be looking to short those that kind of market. You can see here price pushes up, pull back, creates higher high. It created a new high and then a new low. This pattern continues as price moves higher. You see how it just keep continue pushing higher high, higher low. It continues as price moves forward. The same thing with the downtrend. It just keep creating lower low and lower highs. So this is called uptrend, and if it is going down, it is called a downtrend. So let me just quickly show you what a ranging market actually looks like. Good. You see how from the previous market we were seeing the market just keeps going either up or down, but on here the market was just consolidating. It was just consolidating around this box. It created a low, it came back to touch this high, it came back to touch the low, it came back into the high, it came back into the high, it came back into the low, until we finally got a breakout. So this is the type of market that every trader will want to stay away from. There is no clear direction at this time, not until there is a breakout to either the upside like this or the downside just like it did here. You see, after the break and close of this lowest point here. The market just retested it and then it just kept on melting to the downside. So if price is not creating either of the patterns we discussed before, going up or coming down, it is simply moving below its previous highs and low without a clear direction. The market is ranging or consolidating. So whenever you open your chart, the first question you should be asking yourself is price making series of higher highs? Let me zoom out. Is price making series of higher highs and higher lows, or lower low and lower high? The answer to the question will help you understand the current market situation. So for a quick recap, market structure is simply the pattern that price creates over time, either bullish or bearish or sideways movement. Higher highs and higher lows suggest an uptrend. Lower high and lower lows suggest a downtrend. And when neither pattern is present, the market may be ranging. Understanding market structure won't tell you exactly where to enter the trade, but it gives you a framework for understanding what the market is doing. So if you enjoy this video and would like to see how we apply this concept in real market conditions, be sure to join our free Telegram channel. That's where I share the trades I'm taking, market insights, and additional trading content with the community. You find the Telegram group link in the description below. In the next video, we will be looking at support and resistance. I believe we've done a video on support and resistance before, but I will give a broad and easier way to understand support and resistance and how traders identify key areas where price is likely to react. If you find this video helpful, don't forget to like, comment, and share it with someone who might benefit from it. Also, subscribe to the channel and turn on notifications so you never miss future educational videos, weekly market outlook, trade recaps, and market insights. Thanks for watching, and I'll see you on the next one.